Moving on, we are also taking stock of a handful of finance companies and keeping up with the earnings conversation. L&T Finance is also in focus, where the net profit has risen 17%. And the net interest margin guidance, on the other hand, has lowered. And my colleague Harsh Sehta has caught up with Sudipta Roy, he's the Managing Director and CEO at L&T Finance, to decode their Q2 earnings and outlook going forward. Listen in to a slice of that conversation.
Yeah, so, as you said, there have been some systemic/sectoral challenges in terms of asset quality, primarily in the microfinance sector. And obviously, in post the general elections and the heat wave, we had seen some weaknesses also in sort of the unsecured lending. I'm talking about the industry, the unsecured lending industry, as well as some adjacencies in two-wheelers as well. However, the fact is that in Q2 also, we saw certain headwinds with regards to the microfinance sector, and I'll be very quick to point out that though majority of the industry headwinds, from whatever news which is available with us, what we track, is primarily because of customer leverage issues, but our sort of problems have been lesser of due to customer leverage issues, but primarily more due to sort of environmental impacts like the once in 60 years sort of flood situation in North Bihar, the flood situation in South Bihar, as well as in some states, some of the temporal disturbances that were brought about by the stoppage of the social benefit flow on for a couple of months on the backdrop of the general elections. So overall, our sort of collections efficiencies have held reasonably well, though there has been a 13 basis points deterioration from June to September in terms of collections efficiencies. We came in at about 99.43% in the month of September 2024. And I do expect that, sort of the weakness to continue into the month of the quarter of October, November, December from an industry perspective. Other businesses, what the deterioration that we saw in Q1, especially on the backdrop of the general elections and the heat wave, that took time to stabilize. It has stabilized in Q2, and we expect that during the festive period, the situations will improve. So overall, yes, tough quarter, a mixed quarter. But again, what we have done during this quarter is to make sure that our credit engines are furthermore sharpened. As you are aware that we sort of operationalized our three-dimensional credit engine Cyclops last quarter, and we have continued to scale it up this quarter. 55% of our two-wheeler sourcing is coming in through that particular engine, and the initial trends are good. The net non-starters for our Cyclops underwritten portfolio is 125 basis points lower than that done by the legacy algorithms. So though it is in a beta stage, we remain very upbeat about the performance that is coming out of it. So yeah, overall, tough Q2. I think it will be a tough Q3 as well. We have to be cautious, and we have to place every step with an extreme caution. But again, the focus on growth momentum and a risk-calibrated growth momentum will continue with a completely tight control on risk, our portfolio origination, as well as portfolio monitoring.
Sure. So where should credit costs therefore lie in your viewpoint? You've got a good lens as to how things are playing out geographically as well. So 2.5 to 3% roughly being the credit cost H2, is that something that we can expect?
See, without going to specific numbers, the way we have sort of guided the markets is that our credit cost plus OPEX as a block will come in at about 7%. Right. So if you see this quarter, we have had some efficiencies in our overall OPEX. We had come in at 4.17% of book. The credit cost went up to about 2.59% of books, but overall it remains well below that 7% threshold. So, our focus on collections will remain in Q3. We will try to see, how best we can do in Q3, whether we can better the numbers than what we have done in Q2, even though sectoral challenges remain. However, what we will try to do is that the credit cost and the OPEX as a block, we will try to contain within 7%, as guided within 7%, which might mean that we might have to tighten our belts on the OPEX side. So, if, for example, if we see that, there might be a couple of basis points spillage in credit costs upwards due to the sectoral challenges. However, our objective will be to make sure that we continue on a holding pattern.
So where within OPEX are you, trying to taper and trying to control as we are seeing a bit of a spike with regard to where credit cost is concerned?
See, obviously, some of the the calibrated expenses, like expenses on above the line marketing, or making optimization in our technology expenses, especially our cloud costs, as well as barring collections, maybe trying to see if we can optimize our hiring trajectory, etc. So we have several levers which are available with us. So obviously we are working on making sure that we build certain efficiency in our OPEX line, as well as continue to invest in collections. I would like to say that though during the period, we actually have significantly beefed up our collections infrastructure. In the rural business finance or microfinance vertical, we have put in almost close to 1,000 additional people in collections. We have beefed up our collections in our two-wheeler business. We have beefed up our collection strength in our tractor business. So overall, we have invested in our collections business just to make sure that our credit costs remain in a predictable trajectory, as well as on the overall, we have made sure that our OPEX remains in control, so that we are able to guide and come within that 7% block of credit cost plus OPEX.
No, let me credit you on that, Mr. Roy. Your collection efficiency continues to hold up fairly strong despite the spike in credit costs. So, I want to put it out there that I appreciate what you're saying. In terms of margins, and I want to switch picture to the top line. Margins now slightly below 11%. Do you believe that the rate cutting cycle will only aid that number? And sticking with top line, your other income on a year-on-year basis slightly on the muted side. Any levers there for you to up the game on top line?
Yeah, so there has been slight erosion in our NIMs this quarter compared to what we did in last quarter. Obviously, as we calibrate our businesses and move a little more towards the secure side, because of the headwinds on the microfinance side, you have seen that our, Q-on-Q growth on the rural business side has been muted. In fact, there has been a couple of percentage points erosion. Obviously, when a high yield asset gets replaced in the growth momentum by a little lower yielding assets, obviously you have the impact on the NIMs. The second thing which is there is that on the fees, yes, our fees have been range bound, and obviously over the next couple of quarters we'll be taking some more initiatives to see if you can add a couple of more products which are a little more fee originating in nature. And obviously on the last part of your input, I would like to say that the RBI's movement into a neutral accommodation stance is quite welcome. We believe that the downward cycle on policy rates might start sooner than later, and inflation more or less has been remaining on a stable trajectory in the country for the last couple of months. So we are quite hopeful that maybe in December or January of this financial year, we might see the downward rate cycle starts, and obviously that is going to aid our NIMs and fees. One of the important points which I like to point out is that sequentially you would notice that in such an elevated rate regime, our treasury team has done an excellent job and been able to reduce the weighted average cost of borrowing by about 5 basis points between what was there last quarter and this quarter.
Fair point. I want to talk about ROAs. Therefore, you've guided for at the top end of the band a 3% ROA, and the range being 2.8 to 3. You're doing 2.6 currently. You're expecting a spike in credit cost. You're expecting that to be offset by a taper in OPEX. Where should ROAs therefore lie for you for full year FY25 and FY26? Therefore, should that be a better year for you, given that you'll have this margin fillip also to work with regard to rates?
So, these are slightly uncertain times. The fact is that the ROA trajectory also depend on the the overall credit environment trajectory in the country. One of the things which I would like to point out is that our objective will be to even through these difficult times work towards that 2.8 to 3% margin as we have guided as per our Lakshya goals. There might be 1 or 2 quarters of temporary fluctuations in that, though we are trying our best to minimize that, as you said, by OPEX rationalization as well as trying to control credit costs within an acceptable trajectory. We remain confident that we will be closer to whatever we have been delivering over the last couple of quarters over the next 2 quarters. And I do believe that as the downward rate cycle starts, as we sort of come out of this little, and I would say that I do expect that the sort of the credit cost challenges and the sectoral challenges, especially in the microfinance sector, should start improving in the latter part of Q3 because there has been bountiful monsoons. We're seeing good tractor demand. We are seeing some green shoots of resumption of rural demand as well as rural liquidity. So I do expect that the situation to start improving from the latter part of Q3 and becoming much better in Q4. So I do expect that over the next 2 quarters, things will slowly ease towards normal and will help us move towards the trajectory of 2.8 to 3%.
Sure. So moving towards normalization, and what would you attribute the higher current credit cost to be at primarily? Is it certain geographies which are impacting you, or is it overall the system itself facing pressure and therefore you're
Certain
facing
geographies, yeah. So certain geographies are impacted as I said, primarily, our pain is lesser because of leverage. Because you see in our analyst presentation, we also said that, the proportion of customers having more than 4 loans on our portfolio is only 5.7%, right? Which is much, much better compared to sort of the industry averages. So our problem and pain is less due to leverage, but more due to sort of environmental challenges. Bihar is having its worst flood in 60 years, and more than 300 villages are impacted where we are having collection challenges. We earlier in the quarter we saw floods in Gujarat. There are certain states where there was stoppage of social payments during the elections and on the background of elections and because of the government change, etc. Now, those are the states where there is sort of tight liquidity in the market, and that is giving us some headaches in those markets. So overall, it's a mixed bag, lesser due to leverage, more due to environmental considerations. But I would also like to say that we as a company remain focused on making sure that our people are on ground day in and day out and try to sort of collect the amounts due in as humane way as possible, right? So and that is what we have reiterated to our teams, and we are giving our customers enough time to make their payments. So as I said, I see green shoots of improvement in the month of October, and on the back of the rains and on the back of a reasonably good Kharif crop and a possible good Rabi crop, I do believe that rural liquidity conditions and rural economics will improve towards the latter part of Q3 and sort of come into a sort of a greener territory in Q4, which will bode well for the entire microfinance sector.